In a development that has sent tremors through the financial landscape, the resilient American job market defied predictions once again, adding a remarkable 272,000 positions in May. This figure, substantially exceeding economists' forecasts, has upended market expectations and cast uncertainty over the Federal Reserve's anticipated path toward interest rate cuts. The Bureau of Labor Statistics report stands as a stark contrast to the consensus expectation of a more modest 180,000 rise in non-farm payrolls. The data's arrival could not be more pivotal, coinciding with the heated buildup to November's presidential election, where incumbent Joe Biden and his Republican challenger, Donald Trump, vie for the nation's highest office. For the Biden administration, these robust job gains present a double-edged sword. On one hand, they provide a potent narrative of economic strength and job creation during the president's tenure. However, the very same figures may complicate the administration's hopes for relief from the Federal Reserve's current 23-year high interest rate range of 5.25 to 5.5%. In the immediate aftermath of the report's release, the chances of a rate cut before the election, which had previously stood at a formidable 81% for the Fed's mid-September vote, plummeted to a mere 61%, according to market pricing. The dollar, too, reacted swiftly, surging 0.5% against the euro to $1.083. Roger Aliaga Diaz, Vanguard America's chief economist, offered a sobering assessment. Numbers like these confirm our view that inflation is not going to come below 2.8 or 2.9% by December, making it really difficult for the Fed to justify a cut before the end of the year. The central bank's target inflation rate stands at 2%. While markets had previously priced in an interest rate cut by November, the release of the jobs data has pushed that expectation back to December. Treasury bond yields, those closely watched harbingers of monetary policy shifts, surged in response, with the 2-year Treasury yield, which moves inversely to prices and in tandem with interest rate expectations, climbing to 4.86%. Stock futures, too, felt the reverberations, swinging into negative territory as the prospect of a prolonged period of tighter monetary policy loomed larger. Strong job growth and rising wage inflation supports our long-held view that interest rates will stay higher for longer, remarked Torsten Slok, chief economist at Apollo Global Management. We continue to expect no Fed cuts in 2024. This release comes mere days before the Federal Reserve's June meeting, where the central bank is widely anticipated to maintain interest rates at their current levels. The Fed's cautious approach reflects the stubborn persistence of inflation, which has proven more intractable than previously thought. According to the Bureau of Labor Statistics figures, the United States unemployment rate edged up to 4% from 3.9%. Additionally, the payrolls number for April, initially estimated at 175,000, was revised downward to 165,000. Ryan Sweet, chief U.S. economist at Oxford Economics, offered a nuanced perspective. There's very strong job growth, but the unemployment rate did tick up. For the Fed, it is going to be a close call if they can cut in September, but I don't think this report takes that off the table. As the nation grapples with the implications of this unexpected labor market strength, the Federal Reserve finds itself navigating uncharted waters. The central bank's path forward, once viewed as a gradual easing of monetary policy, now appears far more treacherous, fraught with difficult trade-offs between fostering economic growth and taming inflationary pressures. In the crucible of this high-stakes economic landscape, the decisions made in the coming months will reverberate far beyond the realm of finance, shaping the political narrative and potentially influencing the outcome of November's consequential presidential election.